Costs matter. They matter most where they are, 1, very large, 2, easily measurable relative to the value of services provided, and 3, compounded over time, as you've seen. And those are 3 of the defining characteristics of the mutual fund industry. A new environment for investing, which is more likely to be bland than spicy, would not be without precedent. For example, the Dow Jones average was 1,000 in 1966. It touched that another half a dozen times in the next 17 years and was still 1,000 in 1982 before permanently moving upward. Despite the promise of Jim Glassman's Dow 36,000, I think it's at least possible we'll find the market in the trading range, say plus or minus 25% from where we are today, of 10,000. Not for 17 years probably, but for an extended period of time. It's possible. But whatever returns the market may deliver, don't make the mistake of thinking that investors will actually earn those returns. The fact is that few investors ever capture 100% of the market's long-run annual rate of return. Why? Simply because investing costs money. The fact is that a huge proportion of investment success is represented by the allocation of financial market returns between investors on the one hand and financial intermediaries and tax collectors on the other. For investors as a group, market returns minus intermediation costs and taxes equals investor return. It is as simple as that. Costs matter. They matter most where they are, 1, very large, 2, easily measurable relative to the value of services provided, and 3, compounded over time, as you've seen. And those are 3 of the defining characteristics of the mutual fund industry. Fund costs are numerous and substantial. I might even say never-ending. Let me add them up. Management fees and operating expenses now average 1.6% a year. Sales charges, at least 0.5% annualized. Hidden portfolio transaction costs, you don't see these. With funds now turning over their portfolios at 100% a year, an absurd rate. 0.7%, 1%. 1.6, 0.5, 7, that's 6, 2.8% a year. And another opportunity cost of 0.3% a year because funds are rarely fully invested in stocks. 0.3%, aggregate cost 3.1% per year. That may not seem like much, but it would consume 31% of a 10% market return. Throw in the extra taxes investors are socked with as a result of all that hyperactive portfolio trading activity. I'll come back to that in a moment. Could easily take, in the current environment, another 1.5 percentage point, leaving just 1/2 of the market's annual return for the fund investor if the return is 10%. Simply put, there are too many croupiers in the mutual fund casino, and their rakes sweep too wide a swath from financial market returns. Fund investors have not yet focused on the confiscatory power of costs. Why? Because the stock market's return has been so generous. 15% in the last decade meant that the average mutual fund, it won't surprise you, earned 15% before cost, but after cost and taxes, in fact, delivered an estimated net return of about 9%. Result, 10,000 invested in the average fund, profit of $46,000. A lot of money, but less than 1/3 of the profit on the stock market itself, which without costs or taxes grew by $154,000 instead of $46,000. Despite this abysmal shortfall, however, fund investors, I think, felt pretty comfortable because they'd made a lot of dollars even though they had not received a fair share of the market's returns. What happens if the future market return is 5%? Assuming that fund costs don't decline, the tax costs do in a lower return environment, the average fund investor in a 5% market could receive a 1% return, with many stockholders garnering negative return. 5% in the market may not seem like much, but it'll give you $6,000 on a $10,000 investment in a decade. At 1%, it's a $1,000 profit for a decade of investment. I think disappointment would be far too mild a characterization of a shareholder's reaction. So in a future market environment of lower returns, the confiscatory power of excessive mutual fund costs and unnecessary taxes will severely challenge this industry. In many respects, this industry is a child of the great bull market of the past 2 decades. That's why equity funds have gone up 100-fold from $41 billion 20 years ago to $3.7 trillion today. But in a bland market environment, the fund industry would face very serious challenges and will have to get its act together. How? Significant reductions in management fees are long overdue, and if fund directors lack the willpower and knowledge to demand them, investors are going to finally vote with their feet and abandon funds that hold excessive costs, finally forcing down fund fees and operating costs. Transaction costs, another big cost, must also decline as the counterproductive short-term speculation is the focus of so many fund portfolio managers today. The average fund now holds an average position for 11 months. That will have to abate. And once we return to the industry's once traditional, when I came into this business and when I wrote my Princeton thesis, long-term orientation, when the average holding period of stock was not 11 months but 6 years, that's long overdue and would reduce not only fund transaction costs but the heavy tax burden that funds that turnover foists on unsuspecting fund shareholders. It's not coincidental that this gradual shift from investment to speculation has come hand in hand with a shift of portfolio supervision in funds from investment committees to portfolio managers, and then the following development of a star system. Alas, however, I must tell you, the fund industry has produced infinitely fewer stars than it has comets.